Topic introduces fixed income securitization and explains how financial assets are transformed into tradable securities. Securitization is the process of pooling financial assets such as mortgages, auto loans, credit card receivables, or other debt obligations and converting them into asset-backed securities, ABS. This process allows originators to raise capital by selling future cash flows to investors. Securitization plays an important role in modern financial systems because it improves liquidity, diversifies funding sources, and redistributes credit risk across market participants. Understanding securitization is essential for fixed income analysis because these securities have unique structures, cash flow characteristics, and risk exposures compared with traditional corporate or government bonds. The securitization process involves several important parties with distinct roles. The seller or originator is the institution that owns the financial assets and seeks to convert them into marketable securities. The seller transfers the assets to a special purpose entity, commonly called an SPE, which is legally separate from the originator. The SPE purchases the assets and issues asset-backed securities supported by the cash flows generated from the underlying asset pool. A servicer is responsible for collecting payments from borrowers and distributing cash flows to investors. The servicer may be the same institution as the seller or a separate entity specializing in loan administration and collection activities. One of the primary benefits of securitization for issuers is improved liquidity and funding flexibility. By selling financial assets to an SPE, originators receive immediate cash proceeds that can be used to make additional loans or support other business activities. Removing assets from the balance sheet may also reduce regulatory capital requirements, improving leverage ratios and profitability. Securitization therefore enables financial institutions to recycle capital more efficiently and expand lending capacity. Additionally, issuers can often obtain lower financing costs through securitization because investors evaluate the credit quality of the underlying asset pool rather than relying solely on the issuer's corporate credit profile. Investors also benefit from securitization because asset-backed securities provide access to diversified pools of financial assets that might otherwise be difficult to invest in directly. ABS offer a range of risk-return profiles tailored to different investor preferences through structural features such as tranching and credit enhancements. Securitized products may provide higher yields than similarly rated corporate or government bonds because investors assume exposure to prepayment risk, credit risk, and cash flow uncertainty. In addition, ABS markets often exhibit greater liquidity than the underlying loans themselves because standardized securities can be traded more efficiently in secondary markets. These characteristics make securitized products important components of institutional investment portfolios. Securitization also provides broader benefits to economies and financial markets. By increasing the liquidity of financial assets, securitization improves capital allocation and market efficiency. Financial institutions can transfer risk to a wider investor base, reducing concentration exposure and encouraging additional lending activity. Lower financing costs may support economic growth by increasing access to credit for households and businesses. The ability to trade standardized asset-backed securities also enhances price discovery and market transparency. Consequently, securitization contributes to the development of deep and efficient capital markets that facilitate investment, credit availability, and economic expansion across financial systems worldwide. Despite its advantages, securitization introduces several important risks for investors. The timing and amount of cash flows from underlying assets may be uncertain because borrowers can prepay loans, default, or delay payments. Credit risk remains significant because deterioration in the quality of underlying assets can reduce expected investor returns. Prepayment risk is particularly important for mortgage-related securities because declining interest rates may encourage borrowers to refinance early, shortening expected cash flow duration. In addition, securitized products may involve structural complexity that makes valuation and risk assessment more difficult. Investors must therefore carefully analyze collateral quality, legal structures, and credit enhancement mechanisms before investing in ABS. Several important legal and contractual documents support the securitization process. The purchase agreement outlines the terms under which the seller transfers financial assets to the SPE. The prospectus describes the structure of the securitization, including fees, servicing arrangements, and the allocation of cash flows to investors. These documents define investor rights, payment priorities, and the responsibilities of involved parties. Legal separation between the originator and the SPE is critical because it protects investors if the seller experiences financial distress. Proper legal structuring therefore enhances the credibility and credit quality of securitized instruments within fixed income markets. Topic ultimately demonstrates that securitization is a transformative process within modern fixed income markets, providing significant benefits to issuers, investors, and financial systems. By converting illiquid financial assets into tradable securities, securitization improves liquidity, expands funding opportunities, and redistributes risk across market participants. However, securitized products also introduce unique risks related to cash flow uncertainty, credit quality, and structural complexity. Effective analysis requires understanding the roles of originators, SPEs, servicers, and legal documentation supporting the transaction. Mastery of securitization concepts is therefore essential for evaluating asset-backed securities and understanding their broader impact on financial markets and economic activity.